Bank of Canada has increased their policy interest rate by half a percentage, thus continuing their monetary tightening in order to tame record high inflation. Consequently, this is bound to bring more financial burden on borrowers as most of the big banks have already increased their prime lending rate to 6.45%. All this has led to an appreciating Canadian dollar, where currency experts are projecting loonie to hit $1.35 per US dollar in the next 3 months. Now, for those who are new to this channel, my name is Sunny and I make content that help a common man financially. So let's dive into today's topic: interest rates going up in Canada again. Please like, share and subscribe, as that will help boost the YouTube algorithm for my channel, which of course will be highly appreciated. The Bank of Canada on December 7 increased interest rate by half a percentage, which is their 7th consecutive increase so far, taking it to 4.25%. The CPI inflation came at 6.9% in October, but broadly many goods and services that we all use regularly are showing enormous price increases. Just keep in mind, ideally they want inflation to be close to their 2% target and we are way off that number. The fact remains, it takes a while before we can see trickle-down effect of this monetary tightening on inflation. The worry is not to increase the rates too much too soon. The next important date is 25th January next year, when Bank of Canada will announce any other policy decisions. Canadian housing market has become a disproportionate representation of our economy, which is worst in any G7 country. Loose monetary policy and ultra low interest rates are major contributors in my opinion. Until early this year, a 2% 5-year fixed rate encouraged people to buy real estate to invest or to flip, thus turning houses into speculative investment. All this exuberance stopped when, due to high inflation, Bank of Canada started tightening money supply. When the music stopped, anyone holding on to real estate is stuck with increasing rates and falling asset prices. I believe more pain is yet to come. Bank of Canada's focus is on controlling inflation, so this interest rate hike has come down on borrowers as ton of bricks. Interest rate surely is a source of income to a lender, but a cost to a borrower. Ideally, there is a lending rate that makes sense to a lender and a borrower, beyond which it does not make business sense to borrow money. That is where people started to shy away from borrowing, which reduces demand and hopefully inflation. Imagine when your business model is dependent on 3 to 4% lending rate. Now to pay double that will slow down demand, therefore a recession could be a possible outcome. Most of the big Canadian banks have already increased their prime lending rate to 6.45%, thus mirroring Bank of Canada's 50 basis point interest rate hike. This is going to have a disproportionate effect on variable rate borrowings because those rates will go up automatically in most cases. No doubt it is going to affect us all, but households with higher debt levels will be more vulnerable financially. Canada's financial regulator is mandated to secure banking stability in case of higher default cases. Therefore, they are asking major banks to have more capital on hand. This stability buffer is very important to avoid any future financial meltdown. A common man as well as financial experts want to know how high can interest rates go in Canada. I'm afraid there is no simple answer for this. Bank of Canada has got two legal mandates: 2% inflation target and sustainable job market. What government of the day thinks has got no bearing on how Bank of Canada sets their monetary policy. People think government will not allow house prices to fall hypothetically 40% or stock market by 20%. I'm afraid they are wrong. We live in a capitalistic society. Here demand, supply and basic laws of economics determines our financial lives. Until inflation is brought closer to their target rate, this monetary tightening will continue, but surely the pace could change depending upon how inflation behaves. About 30 years ago, mortgage rates were in double digits for a sustainable period of time. until the inflation was brought under control. But that is me. I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor, so please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.